This is the second part of the presentation for Chapter 18, Revenue Recognition. In this learning objective, we will apply the 5-step process of revenue recognition that we covered in the first presentation to major revenue recognition issues. Sales returns and allowances are granted to customers when they purchase products and for various reasons are dissatisfied with them. The company may either grant the customer a full or partial refund, credit that can be applied to amounts owed or future purchases, or another product in exchange. To illustrate the recording of sales with returns and allowances, we will consider vending company that sells 100 cameras for $100 each to Amaya. Vendon allows Amaya to return any unused cameras within 45 days of purchase. Vendon estimates that 3 cameras will be returned, that the cost of recovering the products will be immaterial, and the returned products can be resold at a profit. On January 24th, Amaya returns 2 of the cameras because they were the wrong color. Vendon prepares financial statements on January 31st and determines that it is likely that 1 more camera will be returned. To record the sale of the cameras and cost of goods sold, Vendon would debit accounts receivable or cash for the selling price of $10,000 and credit sales revenue for the same amount. Vendon would also debit cost of goods sold and credit inventory for the cost of $6,000. On January 24th, when Amaya returns 2 of the cameras, Vendon would debit sales returns and allowances and credit either accounts receivable for a credit sale or accounts payable if cash was originally paid for $200. Vendon would also debit returned inventory and credit cost of goods sold for $120. The account returned inventory is used so that the camera's value can be tested for possible impairment separate from the inventory of new cameras. On January 31st, 2020, Vendon will need to record the estimated sales returns and allowances for the 1 camera still expected to be returned. To make these entries, Vendon would debit sales returns and allowances for $100 and credit either allowance for sales returns and allowances if the cameras were purchased on account, or accounts payable if the cameras were purchased for cash. Vendon would also debit estimated inventory returns and credit cost of goods sold for $60. The allowance for sales returns and allowances is a contra account to accounts receivable that is used to reduce accounts receivable for estimated returns. Companies that have repurchase agreements with customers that allow a transfer of an asset to the customer with either an unconditional forward obligation or unconditional right call option to repurchase the asset at a later date may not record a sale if the obligation or right is for an amount that is greater than or equal to the selling price. If this is the case, then the transaction is a financing transaction rather than a sale. To illustrate a repurchase agreement, we will consider Morgan Inc., an equipment dealer who sells equipment to Lane Company on January 1st, 2020 for $100,000 with an agreement to repurchase the equipment on December 31st, 2021 for a price of $121,000. Since the repurchase amount, $121,000, is greater than the original sales price of $100,000, this is a financing rather than a sales transaction. Morgan would record the receipt of the $100,000 in cash by debiting cash and crediting liability to Lane Company for $100,000. At December 31st, 2020, Morgan would record the interest expense on the loan by debiting interest expense and crediting liability to Lane Company for $10,000. At December 31st, 2021, Morgan would record the remainder of the interest expense of $11,000 by debiting interest expense and crediting liability to Lane Company, and the repayment to Lane by debiting liability to Lane Company for $121,000 and crediting cash for the same amount. Bill and hold arrangements involve contracts where the seller bills a customer for a product but retains physical possession of the product until a future date. They typically result from situations where the buyer, for various reasons, is unable to take delivery but does take title and accepts billing. To illustrate a legitimate bill and hold, we will consider Butler Company that sells $450,000 of fireplaces on March 1st, 2020 to a local coffee shop, Baristo. Baristo is expanding its locations and asked Butler to retain the fireplaces until the new coffee shops where the fireplaces will be located are ready. Title passes to Baristo at the time that the agreement is signed. The question is whether Butler has satisfied its performance obligation for the fireplaces and can recognize the revenue even though delivery has not occurred. The questions that must be answered for Butler to recognize the revenue are shown on this slide. The reason that is given for Butler keeping the fireplaces is substantive, and there is no indication that the fireplaces are not ready for transfer to Baristo as soon as the coffee shops are ready. There is also no information to indicate that Butler could easily sell these fireplaces to anyone else. Therefore, it appears that the criteria for recording the revenue have been met at the time the agreement with Baristo was signed rather than when the goods are actually delivered. Butler could record the sale on March 1st, 2020 by debiting accounts receivable and crediting sales revenue for $450,000 and also debiting cost of goods sold and crediting inventory for the cost of $280,000. Another issue that concerns revenue is the principal-agent relationship. For example, when an agent such as Priceline arranges for a principal such as Hertz to provide car rental services to a customer, the revenue recorded by Priceline should only be for the commission that is earned on the sale. Amounts collected by Priceline for the car rental services provided by Hertz are not revenue of Priceline. When manufacturers, consignors consign goods to dealers, consignees, they transfer goods but retain title to them. No revenue is reported by the consignor at the time of delivery of the goods to the consignee. The manufacturer consignor continues to carry the merchandise as inventory on its books until the goods are sold by the consignee. The consignor records revenue at the point of sale, and the consignee makes a commission on the sale. To illustrate consignments, we will consider Nelba Manufacturing Company that consigns merchandise costing $36,000 to Best Value stores. Nelba pays the freight of $3,750 and Best Value pays $2,250 for local advertising costs that are reimbursable from Nelba. At the end of the period, Best Value has sold 2/3 of the merchandise for $40,000 and notifies Nelba. Best Value retains a 10% commission and remits the remainder of the cash due, less the cost of advertising, to Nelba. Nelba would record the transfer of the inventory to Best Value by debiting inventory consignments for $36,000 and crediting finished goods inventory for the same amount. Nelba would also debit inventory consignments and credit cash for the freight cost of $3,750. Best Value does not record any journal entry for the receipt of the goods, but only a memo of the merchandise received. Best Value would record the cost of the advertising of $2,250 by debiting receivable from consignor and crediting cash for $2,250, and later record the sale of merchandise by debiting cash and crediting payable to consignor for $40,000. At the end of the period, Best Value would record the commission revenue and remit the net proceeds from the sale to NELBA of $33,750 by debiting payable to consignor for $40,000 and crediting receivable from consignor for $2,250, commission revenue for $4,000, and cash for $33,750. NELBA would record the receipt of the proceeds and revenue by debiting cash for $33,750, advertising expense for $2,250, commission expense for $4,000, and crediting revenue from consignment sales for $40,000. NELBA would also debit cost of goods sold for $26,500 for the 2/3 sold, and inventory consignments for the same amount. As we discussed previously in Chapter 13, there are two types of warranties. The assurance type warranty, which is provided with new products and included in the sales price, and the service type warranty that is available for an additional fee to cover repairs after the assurance type warranty expires. The service type warranty is recorded as a separate performance obligation, and the revenue is recognized over the term of the warranty after the assurance type warranty has expired. Non-refundable upfront fees that are paid by customers, such as membership or activation fees, are made by customers prior to the delivery of a product or the performance of a service. These fees should not be recognized as revenue in the period received, but should be recognized over the term of the contract as the product or service is provided. In this learning objective, we will describe presentation and disclosures regarding revenue. When presenting contract assets and liabilities, companies report contract assets of two types. One type is the normal accounts receivable that represents unconditional rights to receive consideration because the company has satisfied its performance obligation. And the other type is for conditional rights to receive consideration because the company has satisfied one performance obligation but must satisfy another one before it can bill the customer. We will illustrate the presentation in the next slides. On January 1st, 2020, Finn Company enters into a contract to transfer two products, A and B, to Obermein Company for $100,000. The contract specifies that payment for product A will not occur until product B is also delivered. Finn determines the standalone price for product A is $30,000 and B is $70,000. Finn delivers product A on February 1st, 2020 and product B on March 1st, 2020. On February 1st, 2020, when product A is delivered, Finn records the transaction by debiting contract asset, a conditional asset, for $30,000 and crediting sales revenue for the same amount. On March 1st, 2020, when product B is delivered, Finn has an unconditional right of payment and debits accounts receivable for $100,000 and credits contract asset for $30,000 and sales revenue for $70,000. We have covered contract liabilities in other chapters, but to illustrate the presentation, we will consider Henley Company that enters into a contract to transfer a product to Propel Inc. on July 31st, 2020. Propel agrees to pay the full contract price of $10,000 in advance on April 15, 2020, and Henley delivers the product on July 31st. The cost of the product is $7,500. When the contract is signed on March 1st, No entry is made because neither party has performed on the contract. On April 15th, Henley records the receipt of payment by debiting cash and crediting unearned sales revenue for $10,000. When Henley delivers the product on July 31st, it would debit unearned sales revenue and credit sales revenue for $10,000 and debit cost of goods sold and credit inventory for $7,500. Contract terms are frequently modified, requiring the company to determine whether a new contract and performance obligation are created or if there is a modification of the existing contract. A company will account for the change as a new contract and performance obligation if the promised goods or services are distinct and the company has a right to receive an amount of consideration that reflects the standalone price of the promised goods or services. To illustrate the recording of a modification as a separate performance obligation, we will consider Crandall Company that has a contract to sell 100 products to a customer for $10,000 or $100 per product at various points in time over a 6-month period. After 60 products have been delivered, Crandall modifies the contract by promising to deliver 20 more products for an additional $1,900 or $95 per product, which is the current standalone selling price of the products. Given a new contract, Crandall recognizes the revenue as shown on the slide. The $4,000 revenue for the remaining 40 products at $100 is recognized separately from the revenue of $1,900 for the 20 additional units at $95 each. Companies should account for modifications prospectively, which means that the effect of the change should be recognized in the current and future periods and no change made to previously reported results. If the change to the Crandall contract was treated as a modification of the existing contract, then the revenue on the contract would be recognized using a blended price of $98.33 per product. This amount is equal to the total revenue left to be recognized, $5,900, divided by 60, the total number of products left to be delivered. Under either method, the total revenue recognized of $11,900 is the same. The difference in the two methods is the unit price that is applied to the products as they are delivered. Companies are allowed to capitalize costs to fulfill contracts with a length of more than 1 year when the costs are direct, incremental, and recoverable. Other costs that do not meet these requirements are expensed in the period in which they are incurred. Credit risk or collectability is not considered when recording revenue on a contract. Normal bad debt expense is recorded as an adjusting entry using the allowance method. Companies should disclose both quantitative and qualitative information about contracts with customers, including significant judgments made. Also, any assets recorded from costs to fulfill contracts should be disclosed. In this learning objective, we will discuss the percentage of completion method for accounting for long-term contracts. We discussed in the first presentation that it is possible to record revenue on long-term contracts as the performance obligations are being satisfied if certain criteria are met. Scenarios for recognition are shown on this slide. In the first one, the customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs. An example would be a contract for paving 10 miles of highway. As the paving progresses and motorists drive on the new road, the construction company can record revenue. The second is for work that is done by a company on an asset that the customer controls as the asset is created or enhanced. This might be the case if a company performs services on work in process inventory during manufacturing. The last example is when the company's performance does not create an asset with an alternative use. In this case, the asset is customized to meet the customer's specifications and therefore would not be able to be resold to another customer. Two methods are used to account for revenue on long-term construction contracts: the percentage of completion and the completed contract methods. Using percentage of completion, the company will recognize revenue and gross profit each period based on the progress of the contract. In order to use percentage of completion accounting, both the buyer and seller must have enforceable rights under the contract for payment and specific performance. The other method is completed contract, which recognizes revenue and gross profit only when the contract is completed. We will cover both methods in the presentation. This slide illustrates the cost-to-cost basis for recognizing revenue under the percentage of completion method. The first calculation of percent complete divides the cost incurred to date on the contract by the total estimated cost to complete the contract. This percent is then applied to the estimated total revenue or gross profit on the contract to date. Then any previous revenue or gross profit already recognized is subtracted from the estimated total revenue or gross profit to determine the current period revenue or gross profit. We will illustrate this method in the next slides. To illustrate percentage of completion, we will consider Hard Hat Construction Company that has a contract to construct a $4,500,000 bridge at an estimated cost of $4 million. This contract begins in July 2020 with completion in October 2022. The data for the contract, including cost to date and estimated cost to complete, are shown for 2020 through 2022. The slide also shows the progress billings and cash collected during the years, which occur independently of the calculation of revenue and gross profit on the contract. This slide illustrates the calculation of percent complete for the contract for each of the 3 years. It is important to note that the costs to date are cumulative, which means that the cost for 2021 of $2,916,000 includes the cost of $1 million incurred during 2020, and the cost of $4,050,000 in 2022 include the cost for 2020 and 2021. Another important aspect of this calculation is that the costs to complete are estimates. Notice that in 2021, the estimated cost to complete increased by $50,000. As the company adjusts its estimate of cost to complete the contract, the estimated gross profit on the contract is affected. Since previous estimate for 2020 it used a smaller denominator, the current gross profit will include an adjustment of the previous estimate. This slide illustrates the journal entries that would be made by Hard Hat over the 3 years to record the cost of construction, progress billings, and cash collected. There are some new accounts that are used in construction accounting. First, when costs are incurred on a construction contract, they are accumulated in an account called construction in process. You might consider this to be similar to an inventory account like work in process. However, this account not only holds all of the cost of construction, but also under percentage of completion, the gross profit on the contract that is recognized. Another account is billings on construction in process. This is a temporary account that is used to offset construction in process over the life of the contract to prevent double counting of the cost as they are billed to the customer. Depending on which account, construction in process or billings on construction in process is greater at the end of the year, the company will either have a net asset or liability on the balance sheet. When the contract is complete, construction in process and billings on construction in process will be equal and closed. This slide illustrates the computation of current year gross profit. As we noted in a previous slide, the computation of percent complete is cumulative. Therefore, the current gross profit is equal to the current revenue and gross profit to date minus the amount already recorded in previous periods. In this example, the current gross profit in 2020 is $125,000 because it is the first year of the contract. The $199,000 gross profit in 2021 is equal to the total gross profit to date of $324,000 minus the $125,000 already recorded in 2020. The $126,000 gross profit in 2022 is equal to the total gross profit on the contract of $450,000 minus that already recognized in 2020 and 2021 of $324,000. The entries to record the revenue, expenses, and gross profit are shown on the next slide. Under percentage of completion, the gross profit, expenses, and revenue are recorded at the end of each period as an adjusting entry as shown on the slide. The gross profit is debited to construction in process as we noted in the previous slide. The billings on construction in process and construction in process will be equal at the end of the contract and will be closed. This T account of construction in process shows the recording of the construction costs over the 3 years in black and the gross profit entries made at the end of each year in red. This account is credited and closed at the end of the contract when construction is complete. The computation of the unbilled contract price at the end of 2020 was $225,000. This is equal to the difference in the contract revenue recognized to date of $1,125,000 and the progress billings of $900,000. This amount would be shown as a current asset on the balance sheet. This slide shows partial income statements and balance sheets for hard hat construction for 2020. The revenues, expenses, and gross profit on the contract are shown in the income statement, and the accounts receivable and construction in process less billings illustrated in the previous slide are shown in the current assets section. In this learning objective, we will discuss the completed contract method for long-term contracts. As we mentioned earlier in the presentation, companies may use the completed contract method for long-term contracts. This method accumulates the cost in construction in process, but does not make any interim charges or credits to the income statement for revenues, cost, or gross profit, as we saw in the percentage of completion method. Using the completed contract method, hard hat would debit billings on construction in process and credit revenue from long-term construction contracts for $4,500,000 and debit cost of construction and credit construction in process for the $4,050,000 in cost when the contract is complete in 2022. This slide compares the recording of gross profit recognized by hard hat using the percentage of completion and the completed contract methods. Under the percentage of completion method, hard hat recognized gross profit over the term of the contract, but under completed contract, all gross profit is recognized when the contract is complete. In this learning objective, we will identify the proper accounting for losses on long-term contracts. Under percentage of completion, losses on profitable contracts are recorded in the period when they occur, with a current period adjustment of gross profit recognized in prior periods. No losses are recorded for profitable contracts under the completed contract method. However, when the overall contract is deemed to be unprofitable Losses are recognized in the current period for the entire expected contract loss under both the percentage of completion and the completed contract methods. These are the quiz hints for Chapter 18. As usual, it is a good idea to do the homework before attempting the quizzes. This is the information for the problems for Chapter 18 that will be included in the exam. And this is the end of the presentation for Chapter 18, Revenue Recognition.